Liability-driven investment is a strategy focused on matching assets to future payment obligations. Let's break down how this works. LDI stands for liability-driven investment. It is primarily used by pension funds and insurance companies to manage long-term financial commitments. The goal is to reach a funding ratio where assets perfectly match the value of expected future payouts, minimizing risk. Investors analyze when money will be needed and buy assets that pay out at those specific times to ensure stability. While traditional investing aims for maximum growth, LDI prioritizes certainty to ensure that future obligations can always be met. This chart shows how a portfolio is structured to provide cash at the exact moments the liabilities come due. It is ultimately an exercise in cash flow management, removing the guesswork from long-term financial planning. Understanding LDI helps clarify how large institutions manage risk. Educational content, not financial advice. See you in the next video.